Forex looks like easy income. It isn't. Most beginners blow their account inside 30 trades. Here's why.
When you click Buy Euro USD at a retail broker, you're not buying euros. You're not selling dollars. No currency is actually changing hands. What you're doing is signing a contract with that broker, a CFD, contract for difference, where they agree to pay you if Euro USD goes up and you agree to pay them if it goes down. That's it. Your counterparty isn't the global FX market, it's the broker, one company. And that single fact rewires everything about how retail Forex actually works. Let's anchor the scale because the numbers get misused constantly. The Forex market turns over $7.5 trillion a day. That's the BIS 2022 figure, and every stock market on earth combined doesn't come close. But almost all of that volume is central banks, commercial banks, and multinationals hedging real-world currency exposure. Retail traders, people trading from a phone or a laptop, are a sliver of a sliver. You're not swimming in the same ocean as Citi's FX desk. You're in a tank the broker owns, with prices the broker quotes on contracts the broker writes, which is fine if the broker is properly regulated, and catastrophic if it isn't. That sets up the part that actually kills accounts, leverage. Say you deposit $1,000. Your broker offers 30 to 1. That's the cap EU and UK regulators set on major FX pairs. With that leverage, you can control a position worth $30,000. A 1% move in your favor is $300. 30% return on your deposit from 1% of price movement. Now flip it. A 1% move against you is also $300. 30% of your account gone. And a 3.3% adverse move, which is a normal Tuesday in Euro USD during a CPI release, wipes the deposit clean. That's the kill switch. That's why 70 to 85% of retail Forex accounts lose money. Most beginners learn this inside their first 30 trades. The brokers know it. The regulators know it. They legally require it to be disclosed on every broker's homepage. So what's a sane amount? 5 to 1 effective leverage max while you're learning. Risk no more than 1% of equity per trade. That doesn't mean buy a tiny position. It means size the stop loss so if it triggers, you lose 1% of the account, not 30. That single rule is the difference between a 6-month learning curve and a 3-week funeral. Okay, you've sized down. Now what does the trade actually cost? 3 layers. First, the spread, the gap between buy and sell. On Euro USD at a tight ECN broker, that's around 0.1 pips. At a standard retail account, more like 1 pip, 10-fold difference. Second, commission. Some brokers charge an explicit round turn, about $7 per standard lot, in exchange for those tighter spreads. The standard account broker hides the cost inside the spread. The ECN broker bills it openly. Same money, different invoice. Third, the one beginners never see coming, swap. If you hold past 5 p.m. New York time, you either pay or receive interest based on the rate differential between the two currencies. Hold a low-yield currency against a high-yield one and you bleed every single night the trade is open. That's why a small losing trade you hold for 2 weeks ends up losing way more than your stop loss promised. And then there's everything else that can go sideways. 4 classic failure modes. 1. Bad requotes during fast markets. Demo accounts fill perfectly. Live accounts during a Powell speech don't. 2. Over leverage. Still the #1 cause of blowup even after we just covered it. 3. Withdrawal delays or outright denials at sketchy brokers. Tier 1 regulation, FCA in the UK, ASIC in Australia, NFA in the US, gives you a complaints process and client fund segregation. Offshore regulation gives you a website. 4, and this one's structural. If you're a US resident trading with an offshore broker and something goes wrong, you have essentially 0 recourse. No regulator will take your call. Pick the wrong jurisdiction and you've already lost the case.
So how do you actually start? 6 steps. 1. Pick a Tier 1 regulated broker. FCA, ASIC, NFA. Not a logo wall of obscure island regulators. 2. Open a demo account and trade it for at least 2 weeks. You're learning the platform, the order types, the way the ladder behaves under pressure, not the strategy. The strategy comes later. 3. When you fund, deposit money you can afford to lose entirely. Treat it as tuition, not a war chest, not your rent. 4. Trade the smallest size the broker offers. At most brokers,
brokers, that's 0.01 lots, a micro lot. There is no prize for sizing up in month 1. 5. Keep a journal. Entry, exit, reason for the trade, emotional state, rule breaks. Without it, you can't learn from mistakes. You'll just repeat them with different chart patterns. 6. And this is the one nobody wants to hear. Expect 6 months of losses. The first 100 to 200 trades are where you find out whether you actually have an edge. Most people don't. The ones who do found out by losing slowly and on purpose, not by going big and going broke. Here's the part to internalize. Remember the 3.3% kill switch from the leverage math? That's why this isn't a side hustle. That's why it isn't an income shortcut. That's why every regulated broker is legally required to disclose that the majority of their customers lose. Forex isn't broken. It's working exactly as designed. The leverage is the product. The CFD wrapper is the product. Your job is to use it carefully enough to survive long enough to actually learn the skill underneath. The traders who make it past year 1 almost all share the same boring profile. Tier 1 broker, tiny size, tight risk per trade, journaled obsessively, no leverage hero shots. If that sounds slow, good. The fast version is the one in the statistics.
Forex is a skill, not a shortcut. Trade small, stay regulated. Full breakdown in the description.